Emerging markets are going to remain under pressure as we lead into the midterm elections in the US. I think this is going to be driven by continued and probably accelerating trade hawkishness with respect to the China-US relationship, with the view of obtaining some form of deal in terms of concessions, whether it be market access or whether it be in the area of intellectual protocol protection. So while this is happening, I expect that the US dollar will remain underpinned, which will continue to put pressure on emerging market currencies. Now, moving to India in particular, India is one of the better quality emerging markets in the global space. In fact, in the Asia-Pacific region, it's my number one pick in Asia ex-Japan. So we've had an overweight in India all year, and we've actually taken a very big overweight since July. And the main reason for that is that Indian growth, unlike China or Korea, is not correlated strongly with the global trade cycle, so it's less susceptible to a trade-related shock. Also, earnings are growing at roughly 15% this year. Valuations are challenging, but that premium is deserved, in my opinion, given the strong growth outlook. Now, as far as the rupee is concerned, yes, it's going to be under pressure, but it's not a rupee story. This is a strong dollar story, sort of against, the backdrop of the EM complex as a whole reacting to that. So I see India actually as well positioned, although it still will have some downside with the rest of the EM until some form of deal is struck.
Okay, so you said you have a big overweight on the Indian markets. Would you put fresh money to work now in India?
I wouldn't, not just now. I mean, I think that we're going. So India has outperformed Asia ex-Japan quite significantly. We're sort of, at this stage, risk off. We've had our overweight position there. I wouldn't, from the way in which I look at the region, as I look at APAC. So I'm overweight Japan, underweight Asia ex-Japan, and overweight India in the context of Asia ex-Japan, and overweight consumer in Asia ex-Japan. So that's sort of providing some ballast. Really, what we're looking to do is keep that position there. We're very happy with that overweight in India, but what we're probably looking to do is actually, once it becomes clearer that a trade deal is done, it's then more likely that we're likely to see those North Asian markets outperforming as a relief rally sort of following a trade deal. So in that case, we'll probably be shifting a little bit towards China and Korea at that point. But for the meantime, we're very happy with overweight in India.
Okay. Paul, hi, good morning. The other concern in India, apart from the higher crude prices and the currency impact, has been this move in financials in India, the largest sector, and a bit of a freeze that we had in debt market over the last couple of weeks. Your thoughts on whether this could have some more impact going forward?
Yes, that's a very good question. So I think we all thought that we were past the peak of the financial sector issues with the RBI's risk assessments last year, and that looks like that's not 100% the case. So there has been some more scrutiny on the public banks. And we've also sort of seen some intervention in particular banks, such as putting a cap on sort of the duration that the president of Yes Bank, for example, can in fact express. So there has been sort of a little bit more macro-prudential oversight that has sort of put some pressure on the banks. I, however, am positive longer term on the banks because top-line lending growth is strong, and this steepening in the yield curve that we're seeing in India longer term should be a positive driver for net interest margins. So longer term are actually quite positive. But yes, I accept that near-term sentiment will be a problem.
Okay, I don't know, Paul, if you look at Indian debt markets as well, in the sense government securities market, at plus 8% yield and the rupee at 73.5 or thereabouts, would that become attractive?
I think so. So I think this particular space, given the lack of financial leverage, that's attractive. I think in a risk-off environment, yield is important, But what we've found from our quantitative analysis in India and also in the rest of Asia, ex-Japan, including Japan actually, is that dividend growth is actually more important. So long as these companies are able to grow their dividends faster than the rate of inflation, then you'll have rising real yields against the backdrop of rising bond yields, and that's okay. But what we need to be very, very careful about are no growth or slow growth, high yield companies that will actually see falling real yields and act like bond proxies in this rising bond yield environment.